I've always said that I love dividend investing because nothing is better than having your money make money, which makes your money make more money, which then, well, you get the point. And when it comes to the world of investing, if you ask most successful investors, which amount of money is the hardest to earn? Many of them would say the first $100,000 is the absolute hardest amount of money to save. And why is that? Well, once you've earned 100K and you save it, the next 100K becomes easier because the first 100K is helping you propel towards the second. Now, if you're more of a dividend income focused investor, I'm sure you know exactly what I'm talking about so far. Now, when it comes to investing into higher yielding stocks, especially stocks that have a higher starting yield, there's obvious risks associated with this. But if an investor is able to weigh out the risk versus reward, and if an investor finds himself buying into a company that for whatever reason at that point is extremely undervalued but does have upside potential and is offering a massive starting dividend yield, that could definitely be the diamond in the rough for long-term dividend investors like myself. And although high quality, safe, high yielding dividend stocks are sort of hard to come by, they are still out there if you just dig deep enough. And in today's video, we're going to go through what could still be an undervalued dividend stock, which is currently offering around a 13% starting dividend yield, along with upside potential on the share price. And stay tuned because you are not going to want to miss out on this possible gem for dividend-oriented investors. Now, the company that we're talking about is the Ares Commercial Real Estate Corporation, or ticker symbol ACRE. Now, Ares Commercial Real Estate is a specialty finance company which originates and invests in commercial real estate, or CRE, loans and related investments in the United States. It provides a range of financing solutions for owners, operators, and sponsors of commercial real estate properties. The company originates senior mortgage loans, subordinate debt, and preferred equity products. All of this along with other commercial real estate investments, including commercial mortgage-backed securities. Now, it is elected and qualified to be taxed as a real estate investment trust for the United States federal income tax purposes. Now, some more about ticker symbol ACRE. The stock is currently down around 5.47% as far as year to date. But the share price of Ares Commercial Real Estate has been fighting back almost in the middle point of the 52-week range, where not too long ago the recent lows was $7.51 per share. Now, this company has a relatively small market cap of around $553 million, short interest of around 5%, and what I think a lot of you dividend investors are here for, a starting dividend yield of 13.03%. Now, I know what most of you might be saying. A stock that's yielding over 13% has got to be a textbook yield trap. And for those of you that don't know, a dividend yield trap refers to a situation where an investor is attracted to a high dividend yield offered by a particular stock. But with this, the dividend payout is unsustainable, or the stock's price is declining, or sometimes both. And investors may be enticed by a high dividend yield, as it appears to provide a significant income stream. However, in some cases, high dividend yields may be a warning sign for underlying issues with the company or its stock. And although I will say that most stocks out there that are yielding north of 10% as a starting yield are definitely somewhat, if not obviously, considered dividend yield traps, there are certain companies that are beat up in share price for whatever particular reason, and in some cases, they can be what you would call an accidental high yielder. Now, an accidental high yielder is when a dividend stock is beat up in share price for whatever reason, and it might even be a short-term drop in share price. Like, for example, back in 2020, there was tons of high-quality companies that had starting yields at 4, 6, 8, 10%, which allowed dividend investors a massive opportunity to get into before the yield shrunk as the share prices returned to their highs. Now, I'm not necessarily saying that this is an accidental high yielder, but I'm just saying that it's worth considering. So I know what some of you might be saying, well, why is this stock so beat up? What are the issues going on? Well, during the Q1 2023 earnings for this company, the company reported distributable earnings of 27 cents per share and revenue of $26.5 million, both which missed analyst estimates. Not surprisingly, shortly after, the stock experienced a massive downtrend, along with the rest of the market over the past few months. But even with the rough Q1 earnings, some important takeaways for ACRE is the fact that the balance sheet looks pretty decent. The company has taken steps to shore up its balance sheet with approximately $1.7 billion in outstanding borrowings. Ares has a net debt to equity ratio of 1.9x, and it has increased its liquidity position with more than $225 million available in liquidity with over $150 million in cash. Now, of course, when any company is offering a starting yield of anything around 13% or so. It's important to dig deep into the company's dividend and see if there's been any recent cuts, etc. So looking at Ares' dividend history on the max chart, you can see that at least as far as the last few years, Ares has paid around a 33-cent per quarter dividend along with a special dividend every quarter of around 2 cents per share. Now before this in 2020, Ares was paying around 33 cents per dividend without the special dividend increase. And before that, in 2019 and before, Ares was paying around 25 to 26 cents per share. So what this tells us so far is that there hasn't been any recent dividend cuts. And although the company has had some issues, it looks like the liquidity on hand could sustain the dividend at least for the foreseeable future. But it's important to note that during the last earnings call, the company said that they're going to maintain the dividend, paying a quarterly dividend of 33 cents per share, and the supplemental 2 cents per share, which makes the total dividend amount per quarter around 35 cents per share that you own. Now, of course, a lot of investors are wondering, is the company going to be able to maintain its dividend? Because after all, if dividend investors are interested in buying into this stock as of now, I'm going to go out on a limb and say that's going to be partially because of the high starting dividend yield. But as we mentioned earlier, the company has built up a balance sheet with a relatively strong liquidity position, which should definitely give investors some comfort that the dividends are at least secure for now. It's also important to note that during the last earnings call, the CEO reiterated that the company's commitment to maintain the current level of dividends, where the CEO said exactly this. Historically, on our first quarter calls, we've provided a dividend outlook for the remainder of the year. Based on what we see today, and despite the near-term industry headwinds and credit challenges, we expect to be in a position with our run rate earnings powered to continue our current level of regular and supplemental quarterly cash dividends for the remainder of the year. So in conclusion, is a stock like Ares Commercial Real Estate Corporation worth buying into and trying to lock in a massive starting dividend yield with historical dividend growth and some capital appreciation, which is possible in the near-term future? Well, for me personally, this type of investment, this type of stock within my portfolio would generally be a relatively small amount of my overall portfolio and wouldn't make up of more than, let's say, 1 to 5% of my overall holdings. But being a long-term dividend growth investor, I have personally invested into companies in similar circumstances in the past, which have actually turned out to be pretty good long-term investments. So obviously there's going to be risks associated investing into this stock along with any other stocks in the market. And with the current macroeconomic environment and with the industry that this company is in, it's definitely going to be a challenging one. But with any investment, there's no way to know for certain whether a company will be able to successfully overcome all the challenges, but that's where you have to weigh out the risk versus reward and make your own decision. But I want to hear what you guys think down below. Is ACRE or Ares Commercial Real Estate Corporation a stock that's currently on your radar, and do you personally feel comfortable investing into stocks that carry the same type of risk as something like this? If you enjoyed this video, make sure to please drop a like in the video and subscribe for more content like this in the future. Thanks as always for stopping by, and I'll see you in the next one.